Okay, sorry. Welcome back. I don't know what is really happening, but network is very bad for just no reason. Okay, so like I said before, network took me out of the class. We already talked about liquidity grab and the rest. So I was to show you guys other blogs. Now, remember when we talked about the market cycle where I said the market when it moves up and down, the cycle is completed. If it moves up and down, the cycle is actually completed. Now, this becomes a structural point, which is a point we are interested in using for something actually. So this area becomes structural points in which if market comes back to break above that, all right, we have a break of structure, just like we talked about. Now, there are other blocks every turn, all right. Now, we are looking at two other blocks. Remember, everything in Forex are in twos, right? I assume you guys can hear me. Can you guys hear me? If you can hear me, just drop a chat. Let me be sure you can hear me. Just drop a message. Can anyone hear me? Okay, off black. I can see you. All right, Sonny. Okay. All right, so everything in Forex come in tools. The same way you can buy, which is trading to the upward side. You can also sell. You can make money, of course. You can also lose money. Everything are in tools. So whatever we're looking at bullish and bearish. We cannot look at just one or two. Bullish has to do with the upward movement of the market, which you already learned in the beginners class. Everything that has to do with upward movement is bullish. Downward movement is bearish. So we will be looking for bullish and bearish order blocks. We'll be looking for bullish and bearish trends. Everything will have to be bullish and bearish in order for us to, have a balance kind of stuff. So we will start by, looking at um, order blocks, right? Order blocks are the last candle, last opposite candle at a turning point, all right? Last opposite candle at a structural point. Now, market was actually going up before, started coming down later, all right? You see, market was going up. So at this time, market was creating more of bullish candles, all right, and then it turned back down, creating bearish candle. Now, the last bullish candle before market turned to the downward side is our order block. Same thing applicable to this. If market was coming down and then it turned back to the upward side, the last bearish candle before market started creating bullish candles is our order block. Now, don't get confused at this point. This is a bearish structural point. This is a bearish structural point. This this is a bullish structural point. All right. This is now market needs to for market to be going up. All right. Market needs to break above a bearish structural point for us to know that there is a break of structure to the upward side. Market needs to break below this structural point for us to know because the other block we are going to get here will be bearish order block. The other block we are getting here will be bullish order block. So if we have market creating the structure like this, and then we are getting the last bullish candle before market turn bearish, that last bullish candle before market turn bearish is our bearish order block, right? That is our bearish order block. Now, to this side, the last bearish candle before market actually turned started going up is our bullish order block. is our bullish order block. All right. So let's look at that on chart. Now on charts, you're going to see where market turned from being bullish to bearish, where it turned from being bearish to bullish. So there you should be able to see many other blocks. Now, at this point, market was actually uh, up and then it dropped down. So this is a structural point. We can get other block here, which is actually very clear. We use a rectangle to actually draw other blocks. So this is our other block. This this is our order block. The last bullish candle that we have here is our order block. Now we are using this rectangle. Can you see what I just picked? Is what we're using to draw from the high of that candle to the low. From the high to the low of the candle. Can you see from the high of the candle to the lowest point? All right, from wick up to wick down of that candle. Other blocks are drawn for future use, so we draw it with this rectangle so that we can have a zone which we are going to use in the future. All right, so that requires further analysis, which we are going to get there. Also, this is a bearish order block. Do not forget this is bearish order block. And now the market actually came down, all right, and then it turned from being bearish to bullish. Now we had the last bearish candle. We just drew from the high to the low. Look at this, from the high to the low of the candle. All right. Now this is supposed to be our order block, but if you have anything lower than your order block, make sure to extend it to the end of whatever is lower than your order block. So this is our order block, and this order block is a bullish order block. Right. Do not forget this is a bullish order block, while the one we're drawing up there, this is a bearish order block up here. This is a bullish order block down here. We are calling this bearish order block because when market comes back to it, we are going to sell. So selling has to do with bearish movement. If market comes back to bullish order block, we want to buy. Now, there are many other blocks, like I said, but you're just not going to trade all the other blocks. We have to select the other blocks we trade depending on the strategy we are trading, whether supply or the demand strategy. Whichever strategy we're trading, it has to actually follow one of those. So that's basically what order block looks like. Now, for the liquidity market, all right, I don't know if I can get an example of the liquidity graph. For the liquidity grab market, all right, when market grabs liquidity, do not forget you are trading structures, not the candle. The only thing you need a candle for is the order block. Now, market makers will buy here and then they multiply the position, sell it back down. Market comes back breaking below the last structural point. This order block here is a bearish order block, and it is very important because that is the order block we are trading, because the strategy we're trading here is the liquidity graph strategy. Now, there's what we call imbalance. Imbalance is inefficiency in price distribution, which is seen when market makers actually, take trades and market moves aggressively. Price distribution is supposed to be like this, all right? But when market moves in this format aggressively towards a direction, it creates imbalances, all right? That's basically the thing. So we are likely going to see imbalances here because market makers multiply their position, open a trade, and then they run all the way from up down straight up because of the speed. Now, since we have these as a liquidity graph, I believe you learned this already in the retailers, sorry, in the beginners class. Since we have these, I just want to round up and go to the main strategy which I want you guys to learn, because that's the strategy I'm trading currently and it works. Now, since we already had liquidity graph and then we have imbalances, we have market breaking below structure. What we are expecting is mitigation, which is what market will take the market back to your point of interest for you to start selling from there. Setting stop loss above that. This is basically the liquidity grab strategy. What you did not learn was liquidity in details, the order block, all right, break of structures, the market cycle, all right, where now the major thing I want to share with you guys tonight is the strategy I love so much, which I trade almost all the time. All right, once it enters my 18, I trade it supply and demand. Supply and demand. There is no way you could learn this in the beginner's class, or there is no way you could also learn this in the retailers class. All right, this is a very powerful strategy that I want you to stick to. Do not stress your head trying to learn too much. The less you learn, the better it is. All right. Now, this is it. Supply and demand. Actually, in real life, once we talk about demand, it has to do with it's either high demand or a higher price. Now, once the demand is high, the price rallies to the upward side. Once there is a supply, in fact, once the goods are too much or the supply chain is too much, in fact, as long as we are talking about supply, we are looking at the price coming down, all right, or supplying to people that demanded for it. Now, I don't know whether you notice once there is high demand of anything, price of that thing do actually increase, all right. Once we have or once the price of something increases, you just see a lot of people showing interest in buying that. That's how it works. It's just like now, if your price will increase again, rallies. If it should rally one time, you will see a lot of people at the petrol station trying to buy fuel, and you'll be asking them what happened when the fuel did not rally this much. That is definitely the thing. So once there is high demand, the price goes up. Now, in Forex, we're looking at structures and we're looking at technical analysis. So every move to the upward side is a demand. All right. Every move to the downward side is a supply. So we can have demand pushing the market up, supply taking the market down. If demand is able to move, break above the supply, which is this structural point. Now look at this demand movement, supply movement. Demand takes overshadows the supply, like it takes over the market to the upward side. We come back here to the downward side, draw that other block that actually took out this, well, broke this structure, and call it our demand order block. Same thing applicable to supply. All right, if we have this supply, market move up, which is the demand, and then supply breaks below the demand, so we have this to be our supply order block. Now, there's something I want you to learn. People talk about rally-based rally in economy, drop-based drop. Of course, that is the thing in Forex. So demand is always rally-based, which is demand dropping, creating supply-based rally. In for supply, we're looking at drop-based drop. So this becomes your supply zone. Every time you have rally-based rally, you have demand. Every time you have drop-based drop, you have supply. So you can have drop, base, drop, base, drop. All right, base, drop. All of these are your supply zones. All right. Then if you have rally, base, rally, base, rally, base, rally, these are your demand zones. All right. Now, how do you trade with this? There is what we call inducement. All right. I'm just introducing you to another component. There's what we call inducement. Inducement is another form of liquidity that market makers use to trap retail traders. Retail traders are interested in trading double top. So if they see something like this, they will wait for the market to come back. Once market comes back to it, they start selling from there. So they see this double top, which is what we see as inducement. It could be there is a point of interest up there, since they do not know about it, they just trade double top, double bottom, and they lose money at the end of the day. So this is how that thing works. Let's say um you have a trade based on liquidity graph, right? This is your point of interest. Now you see market coming very close to your point of interest without getting there, and then it drops. Retail traders see this as a top, and they are willing to sell if market comes back to that line. All right. Now market coming back to that line, this is what we call inducement. Market coming back to that line, they take sell, setting stop loss. What does market do? It takes their stop losses, tap into the point of interest, and then it drops from there. So this now was an inducement. It was just an inducement. It was to induce retail traders, was to get them to come in thinking it is that setup they're looking for, so that they could lose money, you know, because of that. So that is what inducement is. Now, in trading supply, we want to have something like drop, base, drop. Now, this is our supply zone. Now, we want to have another supply dropping again, still breaking below this. This supply now will act as inducement, all right? Because the market comes back to this, retail traders want to take their sales, but then this may be an inducement where market takes the next supply. And then this is definitely what I have been trading. Now, after this class, go back to the free Telegram channel. Check the analysis I've been posting. Recently, I shared one of the cutest analysis, and people just didn't know what it was. They played with it and all of that. Then for demand, if you have rally, base, rally, this is your demand zone. Now, you need market to create an inducement for you by creating another demand, so that you see this as an inducement. If market comes back now, you trade this particular one, all right, you buy from this particular order block, all right, not this one, because this one now is acting as inducement. Inducement is necessary to confirm that this is where market makers are actually setting trap for retail traders. Once liquidity is taken, either in form of liquidity or in form of inducement, you will see that it is likely going to go after that. All right, someone says it's not in the free Telegram channel. Actually, it's not the free class group. Free Telegram channel on Telegram. I'm going to send the link to your class group so that you can join. Now, for about what you're learning just now, if you check what I did here on gold before the comeback, if you check this trade I took on gold, you will see that analysis was based on that. The analysis was based on that. Now, this is it. We had this market push up, drop down. All right, push up. I just want to show you guys this one first. So we had rally, all right, base rally, which gave us the demand first of all. So we had from here rally, base rally, giving us demand, and then you see this it drop push up, creating another demand which is acting as an inducement. Market came back to this particular demand, which is where it actually moved. This particular trade for on the AED NZD was a perfect kind of supply, which is what I was trying to explain. Now look at this trade. Look at this trade. We had drop, base, drop. All right, so that gave us a supply zone, all right, and then again it rallies again, then it drops again, breaking below this particular one, so giving us this particular supply as inducement. As you can see, as market came, it skipped this one, pushed to the order supply, and then it's sold all the way from there downward. Now, this is what I was trying to explain, which is actually very simple. I'm going to send the link to you guys so that you can join the Telegram channel. I believe you will have so much to learn from there. Now, if you have any question, you can always type it to drop on the class group. Feel free to send voice note to that class group, all right, on Telegram. Feel free to send voice note if you have something you need to explain, because it's not everything you'll be able to type. So you can send voice note, you can make screen recording. Anyhow you want to pass the information, anyhow you can be able to ask your question. Make sure you ask. That's why I'm on the class group, so that I can answer all your questions. Okay. I don't know what has been happening to network, but this class must happen. Okay, so that will be all for tonight. By tomorrow, I'm still going to go through the supply and demand again so that you will really understand. Thank you very much for your time. I'll send this recording for you to watch and also send link for you to join the Telegram channel. Good night, everybody.